Today, I've been tasked with doing a shallow dive, a little review on the company Polaris, ticker symbol PII. So, I'm really happy to review this company because it's not a foreign company, it's not ADR or some kind of weird growth company that's fully story based. So, this is the company here. It had a down day minus 3.14% on Friday. And let's take a look at some of the numbers and see if those kind of movements are justified for the company. Now, jumping into the financials, I immediately see some really good things. Now, I normally like to look at quarters, so it gives me a bit more definition of what's going on with the company, higher resolution, if you will. And it looks like the company doubled its revenue more or less in the past, call it 7 years, which is extremely encouraging. I like that a lot. So that's a big plus. There are many other pluses on the surface of the company when you look at it. So this is the net income. Yes, the last quarter was negative, but I'm sure that's not going to persist. I'm sure they're feeling a lot of inflationary pressures. Probably their costs are going up, and they don't want to pass that on to the consumer. They're in, an interesting business. The company basically produces vehicles and vehicle parts, and designs and manufactures all kinds of vehicle-related things. So, personally, I like companies like that. They're interesting and they're doing something real and productive, which I like, even if it's for sport purposes. Now, other good things besides the revenue factor is this chart here, which shows the outstanding shares being reduced by a considerable amount, basically every year by a few percent, which I really like. It gives a lot of value to the shareholders and kind of a sense of consistency with the company. You know what they're going to do. Every once in a while, they have to sell down shares in order to probably finance something near term, but the overall trend is down, which I really like. It makes you as a shareholder a bigger part owner of the company every time they they buy back shares. So that's another really big plus. Look at this. This is also a plus. They like to raise dividends. It's a little bit of an inverse exponential graph, though. If you notice, they've been raising dividends by less and less each year. It looks like they do it once per year, and then the dividend stays constant for the entire year. So for this year is 64 cents per share. So another couple quarters, I guess, of 64 cents, then they'll raise it a little bit. So it's great to have a history. This is a 10-year history of raising dividends, but we'll get into why that's not necessarily telling the whole picture in a second. Now, when we go into the statistics, we'll see that the market cap of the company is 5.7 billion, but the enterprise value is 7.52 billion. That means that the company is holding about $1.8 billion of debt, which is a considerable amount, especially for a company like this, because it's a very heavy material based kind of company. It's hard to squeeze out profits. And if you scroll down to the shortened version of the balance sheet, you'll see that in fact their cash position is minus $1.82 billion. Now, that wouldn't necessarily be a problem if they had a really good way of financing it. However, we can't tell by the financials, but we can tell by we can't tell by the incomes, but by the balance sheet, you will see that if we scroll all the way down to where is the total debt, cash growth, I'm missing it. Oh, there we go. You'll see that the debt has been steadily increasing. It kind of peaked out in 2018, then it got reduced a bit by 2020, but now it's near the 2018 peaks. But in 2012, 2015, the debt was only 500 million. So although the company is buying back shares and issuing ever increasing dividends, and it seems really stable and conservative and looks out for shareholders on the surface, beneath they're accumulating debt. And with the earnings dropping in the last 4 or 5 quarters, it's looking increasingly more difficult for them to be able to service that debt. If you look at their earnings per quarter, it's actually not that big. We got $2 billion basically dollars to service. And let's go to quarterly, excuse me. Net income common. And you can see that they made one of their biggest quarters was 200 million, but in 2021 the 160 million, then 114, 86, 69, and then a negative 4.6 million. So these numbers are not enough to service a $2 billion dollar debt and actually make a dent in it. It looks like they have been using a lot of that to just have ever increasing revenues. So, on many metrics, this company looks very, very good, but the whole thing is being basically financed through debt. So for that reason, right, unless the company proves to me that it can have sustainable share buybacks and dividends without growing their debt, I will have to stay on the sidelines for it. I do like the company. I like companies like it. I think it's a good company. Is it going to go broke tomorrow? Absolutely not. Is it going to be able to service its debt for many years to come? Yes, unless they do something stupid. However, there's another cog that's been thrown in there into their calculus, is the rising interest rates. Now, when they have to refinance that debt, I have no idea what their position is and what their debt spread looks like, because this is a shallow dive, not an in-depth dive. Apologies. However, when they do have to refinance that debt, they'll be stuck with a lot higher interest rates that are the norm for the markets. And that interest is actually going to start weighing on the company. Most of the earnings are going to end up being used to just service the debt, to just pay interest on the debt that they already have. And it's going to severely slow down the company's prospect to keep increasing their top line, and it's going to end up shrinking their bottom line. So I would have to say it's a pass. I do like it, but unless the conditions improve and the debt gets reduced and the company shows to me that they can maintain buying back shares and never increasing dividends without increasing the debt, at that point, I think the company will be a buy. That's it for now. Peace out.